Before we dive in, a quick disclaimer. Please remember, I am not a licensed financial advisor or insurance agent. This presentation is for educational and entertainment purposes only. The information provided is based on my own research and experience. You should always consult with a qualified professional before making any financial decisions, and do your own due diligence. Your individual results will vary. That email hits your inbox. The subject line reads, "Your auto policy renewal." A little knot tightens in your stomach. You click it open, you scroll past the corporate logo and the friendly-sounding jargon, and there it is. The number, the new premium, and it's higher. Again, you rack your brain. You didn't get a ticket. You didn't get into an accident or file a claim. Your car is a year older. For crying out loud, it should be worth less to insure. So why in the world are you being asked to pay more? Feels personal. Feels unfair. It feels like you're being punished for being a loyal customer. And I'm here to tell you you are. This is not an accident. It's not a mistake in their system. It is a deliberate strategy. In the industry, it's known as the loyalty tax. And it is one of the insurance world's dirtiest and most profitable secrets. The entire business model of many major insurance carriers is built on a simple bet. They are betting that you are too busy, too confused by the process, or just too complacent to do anything about it. They are banking on your inertia. And because of that bet, they are quietly siphoning hundreds, even thousands of dollars out of your bank account every single year, for no reason other than the fact that you stayed with them. Don't just take my word for it. Study after study has confirmed this. The average American driver overpays for their car insurance by over $700 a year. Let that number sink in for a second. $700. That's a round-trip flight to Miami. That's a new laptop for your kid. That's $700 you could be putting into your 401k, your savings, or towards that vacation you keep putting off. It's your money, and they are taking it from you for absolutely no reason other than they know they can get away with it. Well, that ends today. Right here, right now. In this guide, I am going to give you the complete 2026 playbook to flip the script on the insurance industry. I'm not just going to show you a few tips on how to get a cheaper quote. I'm going to teach you how to make these billion-dollar insurance companies compete for your business. I am going to give you a step-by-step, paint-by-numbers system to find the absolute rock-bottom price for the exact coverage you need, without spending hours on the phone getting the runaround, and without feeling like you need a law degree just to understand your own policy. By the end of this presentation, you will be in complete control. You will know the exact websites to use that force a bidding war for your policy. You will have a checklist of hidden discounts to ask for that most agents will never volunteer on their own. And you will understand the psychological tricks they use in their marketing and renewal letters to make you overpay, so you can spot them, sidestep them, and shut them down for good. Now, I know what some of you might be thinking because I've been there. You're thinking, shopping for insurance is a nightmare. Takes forever. I don't have time for that. Or maybe you're thinking, I don't want to switch, I actually like my agent. Or the most dangerous one of all, I know how to get a lower bill. I'll just raise my deductible to $1,000 and drop my liability limits. Let me be crystal clear about something. We are not going to sacrifice your protection to save a buck. That is a fool's game, and it's exactly what they want you to do. We are going to get you better coverage or the same coverage for a dramatically lower price. And we are not going to spend all weekend filling out forms. The system I'm about to show you is fast, it's efficient, and it's designed for busy people. In fact, I'm willing to bet you can save more money in the next 45 minutes following these steps than you'd make working a full day at your job. So let's pull back the curtain. How do they actually do it? How do they get away with charging you, a loyal customer with a perfect driving record, hundreds of dollars more than a brand new customer with the exact same car, living at the exact same address? The secret is a sophisticated algorithm and a concept called price optimization or price elasticity. It sounds complicated, but its function is brutally simple. Their computer algorithm doesn't just look at your driving record, your age, or your car anymore. That's old news. The new frontier, the data they really care about, is your behavior as a consumer. The algorithm constantly analyzes you, asking questions like, how likely is this person to actually go out and shop for other quotes? Have they ever complained about a price increase in the past? Do they live in a zip code where people tend to stick with the same provider out of habit? Do they use autopay, which makes them less likely to scrutinize the bill each month? All of these little data points paint a picture of how sticky you are as a customer. The stickier you are, meaning the less likely their data suggests you are to leave, the more they can algorithmically raise your rates without consequence. They know you won't go through the perceived hassle of switching, so they squeeze you. A little 5% increase here, a 7% increase there. It adds up year after year after year. It has absolutely nothing to do with your risk as a driver, and everything to do with their calculated assessment of your inaction as a consumer. It's a game, and for years you've been playing it without knowing the rules or even that you were on the field. But knowing the rules is how you start to win. The very act of shopping for a new quote online, the first step in our system, shatters their algorithm. It sends a massive digital red flag to their system and the systems of their competitors that says, "Warning. This customer is no longer sticky. This customer is an active shopper. They are a flight risk." And in an instant, everything changes. Suddenly, you're not a passive cash cow to be milked anymore. You are a valued customer they are about to lose to a competitor. And that is the moment the power shifts from them back to you. The key is not just to shop, but to shop smart. To use a systematic approach that forces the entire market, dozens of companies, to bid for your policy at once. It's about creating a hyper-competitive bidding war where you and your policy are the prize. So here's the game plan, our roadmap to saving you hundreds of dollars. First, we're going to build your master quote profile. This is your digital weapon, a complete and accurate summary of your driving history, your vehicle, and your coverage needs that you can deploy across the internet in minutes, not hours. This alone will save you an incredible amount of time. Second, I'm going to introduce you to what I call the quote stack method, a specific sequence of using different types of quote comparison websites to maximize competition and uncover hidden, unpublished rates that you would never find by just calling an agent or visiting one company's site. We'll cover the big aggregators you see on TV, the powerful independent agent portals you've probably never heard of, and even the direct-to-consumer tech disruptors that are scaring the old guard companies to death. Third, we will go on a scavenger hunt for every single discount you are legally entitled to. We'll go way beyond the obvious ones like good student or bundling. We're talking about the obscure ones like the affiliated credit union member discount, the professional organization discount, or the low-mileage telematics discount that can slash your premium by 30% or more all by itself. Finally, I'll give you the negotiation script, the exact words to use when you take your lowest, most competitive quote back to your current insurer and give them one last chance to keep your business. Most people are too scared to do this, and they leave hundreds of dollars on the table every single year because of it. But before we can build your profile or start stacking quotes, there is one fundamental concept you must understand. It is the single biggest hidden factor that determines your rate, and it's something almost no one in the general public talks about. It's not your car, it's not your driving record, and it's not even where you live. It's your insurance score. And most drivers have no idea what it is, how it's calculated, or how to dramatically improve it. Understanding this score is like having the cheat codes to the entire insurance game, and that's exactly what we're breaking down next. So what is this secret number? It's officially called an auto insurance score, or sometimes a credit-based insurance score. And it's not the same as your FICO score, but it's built from the same raw material, your credit report. Think of it like this. Your credit report is a giant book about your financial life. Your FICO score is one interpretation of that book, focused on how likely you are to repay a loan. Your auto insurance score is a different interpretation, one that insurance companies have created to predict how likely you are to file a claim. And the difference it makes is staggering. Let me paint a picture for you. Imagine two drivers, let's call them Alex and Ben. They are identical in every single way that you'd think matters for car insurance. They're the same age, live in the same zip code, drive the exact same 2024 Honda Accord, have the same job, and this is the important part, they both have a perfectly clean driving record. No accidents, no tickets, nothing. When they go online to get a quote, Alex gets a price of $150 a month. Ben, on the other hand, gets a quote for $280 a month. That's $130 more. Every single month. Over a year, Ben is paying over $1,500 more for the exact same coverage on the exact same car, despite being an equally safe driver. What's the difference? Alex has an excellent auto insurance score. Ben's is poor. This is happening to millions of Americans right now. They're being penalized not for their driving but for their financial history. Now you might be thinking, that's not fair. What does my credit card balance have to do with how I drive? And that's the multi-billion-dollar question. Insurance companies have spent fortunes on actuarial studies, and what they claim to have found is a strong correlation. Their data suggests that people with lower credit-based insurance scores tend to file more claims. Not necessarily that they cause more accidents, but that they file more claims. Maybe they're more likely to file a claim for a small fender bender that someone with a better financial cushion might just pay for out of pocket. Maybe their financial stress translates into being slightly less attentive behind the wheel. The insurers don't really care about the why. They just care about the correlation. They see a person with a low score as a higher risk and they charge them more. Period. In all but a few states, this is perfectly legal. It's the hidden engine running the entire quote machine. So, if you want to stop overpaying, you have to stop ignoring this score. You have to take control of it. So how do we do that? First, we need to understand what actually goes into this score. While the exact formulas are proprietary, a secret sauce each company guards closely. They are all based on the 5 main ingredients from your credit report. Number 1, and the heavyweight champion of them all, is your payment history. This accounts for the biggest chunk of your score. Do you pay your bills on time? Every time? A single late payment on a credit card, a car loan, or a mortgage reported to the credit bureaus can be a significant blow. To an insurer, a history of late payment signals unreliability, and they translate that to you being an unreliable, and therefore more expensive driver to insure. Number 2 is your credit utilization ratio. This is a fancy term for a simple concept. How much of your available credit are you actually using? If you have a credit card with a $10,000 limit and you have a $5,000 balance, your utilization is 50%. This is a huge red flag for the scoring models. High utilization suggests you might be overextended, financially stressed, and again, in their eyes, a higher risk. The magic number you always hear is to keep your utilization below 30%. But honestly, the lower the better. People with the absolute best scores often keep their utilization in the single digits. Number 3 is the length of your credit history. How long have you been managing credit? A longer history of responsible use is always better. It shows a consistent track record. This is why financial advisors tell you not to close your oldest credit card account, even if you don't use it much. That account acts as an anchor, showing the length of your good behavior. Number 4 is your credit mix. The models like to see that you can responsibly handle different types of credit, what's called revolving credit like credit cards and installment loans like a car loan or a mortgage. It shows you're a well-rounded and experienced borrower. And number 5 is recent credit inquiries. How often are you applying for new credit? If you apply for 5 new credit cards in a single month, it looks like you're desperate for cash. This is seen as risky behavior. A couple of inquiries a year is normal, but a flurry of them will temporarily ding your score. So, payment history, credit utilization, length of history, credit mix, and new credit. Those are the 5 pillars. Your auto insurance score is built by analyzing these 5 areas of your financial life. Now for the cheat codes. How do you actively and quickly improve this score to slash your insurance bill? This isn't about some vague advice like be better with money. These are tactical, actionable steps you can start taking today. First, you become the detective. You need to get a copy of your credit report from all 3 major bureaus: Equifax, Experian, and TransUnion. Do not pay for this. Federal law entitles you to a free report from each of them every single year. The only site you should use for this is annualcreditreport.com. That is the official government-mandated source. Once you have those reports, go through them with a fine-tooth comb. You are looking for errors, and you will be shocked at how common they are. A study by the FTC found that 1 in 5 consumers had a verified error on their credit report. That's 20%. You might find an account that isn't yours, a late payment that was actually on time, or a collections account that should have been removed years ago. Each one of these errors could be a dead weight, dragging your score down and costing you hundreds, if not thousands, of dollars on your insurance. If you find an error, you dispute it immediately. Each credit bureau has a straightforward online dispute process. You file the dispute, provide any evidence you have, and they are legally required to investigate it, usually within 30 days. Getting a single negative error removed can cause your score to jump up significantly, almost overnight. This is the single fastest way to potentially improve your score. Second, attack your credit utilization. This is the next biggest lever you can pull for a quick boost. Look at all your credit card balances. If any of them are over that 30% utilization mark, prioritize paying them down. If you have $500 to put towards debt, don't spread it out. Use it to get one card from, say, 70% utilization down to 20%. The scoring algorithms will reward that change much more than a tiny reduction across multiple cards. If you can't pay it down quickly, you can also call your credit card company and ask for a credit limit increase. If they grant it, your utilization ratio instantly drops, even without paying a dime. For example, a $2,000 balance on a $5,000 limit is 40% utilization. But if they increase your limit to $10,000, that same $2,000 balance is now only 20% utilization. Your score will go up. Third, automate everything. Your payment history is critical and life gets busy. The easiest way to ensure you never have a late payment again is to set up automatic payments for at least the minimum amount due on all of your accounts. You can always go in and pay more manually, but this creates a safety net. One late payment can stay on your report for 7 years. Automating it is a simple 5-minute task that protects you for years to come. These 3 actions, disputing errors, aggressively managing your utilization, and automating payments, are the core of the strategy. They address the biggest factors in your score and can produce the fastest results. Improving your credit mix and length of history are longer-term games, but these first 3 are the sprints you can win right now. Now, it is important to note that a few states have put their foot down on this practice. California, Hawaii, and Massachusetts have banned the use of credit information in setting auto insurance rates. In a few other states like Maryland, Michigan, and Utah, its use is restricted. But for the vast majority of the country, your insurance score is a critical and often decisive factor in the price you pay. By taking these steps, you are reverse engineering the system. You are cleaning up the exact data that the insurance company's algorithm will analyze. So when you go to get that quote in a few months, the computer won't see you as a high-risk profile. It will see a clean report, low utilization, and a perfect payment history. It will see a responsible individual, and it will be forced to offer you a much lower rate. But here's the crucial thing to understand. Even with a perfect driving record and a newly polished top-tier insurance score, you can still make one catastrophic mistake. A mistake that millions of people make every single year. It happens right at the moment you actually start shopping for quotes, and it can completely undermine all the hard work you just put in. This single mistake is the insurance industry's best friend, and it ensures that even savvy customers often end up overpaying anyway. And that's the trap we're exposing next. It's called the apples to oranges trap, and it's the #1 reason people who shop for insurance still end up with a terrible deal. It's a psychological sleight of hand, and it works by preying on your desire for a simple, low number. Here's how it unfolds. You go to a comparison website, or maybe directly to an insurer's page. You enter your info, your car, your driving history, and then the website presents you with a quote. Let's say it's $79 a month. Wow, that's fantastic. It's $50 less than you're paying now. You feel that little jolt of victory, the thrill of a savvy shopper who just beat the system. You click buy and you pat yourself on the back. But what you didn't see, what was buried in the fine print or defaulted to the lowest possible option, was the coverage itself. That $79 quote wasn't for the same level of protection you had before. It was for the bare bones, legally required to drive, hope and a prayer policy. You didn't compare 2 identical insurance plans. You compared a fully loaded apple to a tiny shriveled orange, and you chose the orange because it weighed less on the scale. Let me tell you about a guy named David. David is a smart guy, an accountant meticulous with his finances. He decided to save money on his car insurance. He spent a Saturday morning getting quotes from 5 different companies. He created a spreadsheet. Company A was $140, Company B $130, Company C $95. David, feeling like a financial wizard, went with Company C. He was saving $45 a month. That's $540 a year. He felt brilliant. 8 months later, David was driving home on the freeway during a rainstorm. The car in front of him slammed on its brakes. David reacted, but the wet pavement wasn't forgiving. He skidded and rear-ended the car in front of him, a brand new Lexus. Thankfully, no one was seriously hurt, but the damage was significant. The Lexus had a crumpled rear end, and David's own sedan had a smashed front grille and a crumpled hood. David wasn't worried. Frustrated, yes, but not worried. This is why I have insurance, he thought. He called Company C, filed the claim, and waited. A few days later, the call came. The adjuster was polite but firm. The damage to the Lexus was $28,000. The problem? David's $95 a month deal only included $15,000 in property damage liability. That was the state minimum. That was the default option he'd clicked on his spreadsheet. The insurance company paid their $15,000, The remaining $13,000? That was now David's personal bill. Suddenly, his $540 annual savings had vanished. In its place was a $13,000 debt. But it got worse. The adjuster then asked about the damage to his own car. David said, "Well, the estimate is about $6,000. There was a pause on the line. The adjuster said, "I'm sorry, Mr. Henderson, but your policy doesn't have collision coverage." To get that $95 price, David hadn't just accepted the state minimum for liability. He had also waived coverage for his own vehicle in an at-fault accident. So now, on top of the $13,000 bill for the Lexus, he had to pay $6,000 out of his own pocket to fix his own car. A $19,000 catastrophe, all born from saving $45 a month. David didn't get a deal. He bought a ticket to financial ruin. This story happens every single day. The only way to avoid it is to stop hunting for the cheapest quote and start hunting for the best value on a specific, robust policy. You have to define what you're buying before you ask for the price. You have to force every company to quote you on the exact same high-quality apple. So let's build that apple right now. This is the most important part of this entire guide. Forget the price for a minute. Let's talk about what actually goes into a policy that protects you instead of just being a piece of paper that makes you legal. There are 5 core building blocks. First and most important is liability coverage. This is the part that pays for the other guy when an accident is your fault. It doesn't cover you or your car at all. It covers the damage you cause to other people and their property. It's broken into 2 parts: bodily injury and property damage. You'll always see it written as 3 numbers, like 25/50/15. This is insurance speak. Let's translate it. The first number is the maximum amount in thousands the policy will pay for injuries to a single person in the other car. So 25 means $25,000. The second number is the maximum amount it will pay for all injuries in the other car combined. So 50 means $50,000 total. The third number is the maximum it will pay for damage to the other person's property. Usually their car, but it could be a mailbox, a fence, whatever. So 15 means $15,000. The numbers I just used, 25/50/15, are a common state minimum. And they are terrifyingly low. One semi-serious injury, one trip to the emergency room, can easily exceed $25,000. And what's the average price of a new car today? Over $45,000. That $15,000 in property damage is a joke. If you total someone's new pickup truck with a state minimum policy, you could be on the hook for $30,000 or more personally. Your savings, your wages, your future, all at risk. So our first rule: never ever get state minimum liability. A smart, protective baseline for most people is 100/300/100. That's 100,000 for a single person's injuries, 300,000 total for injuries, and 100,000 for property damage. This is your first component of our high-quality apple. Second building block: uninsured and underinsured motorist coverage. Let's call it UM/UM. This protects you when the person who hits you either has no insurance at all, or they have a cheap state minimum policy that can't cover your bills. Think about it. You've been responsible. You bought a great policy, but then you get hit by someone who broke the law and didn't buy insurance. Who pays for your medical bills? Who pays to fix your car? This coverage does. It steps in and acts like the insurance the other driver should have had. It is shockingly inexpensive and absolutely critical. You should always have UM/UIM coverage that matches your liability limits. So, if you have 100/300 in liability, you get 100/300 in UM/UIM. Third building block: collision coverage. This is simple. This pays to fix your car after an accident that is your fault. Remember David? He skipped this and had to pay $6,000 himself. If you have a car loan or a lease, this is almost always required. But even if your car is paid off, if you couldn't afford to just go out tomorrow and buy a new one with cash, you need collision coverage. This coverage comes with a deductible. That's the amount you pay out of pocket before the insurance company pays the rest. A common deductible is $500 or $1,000. A higher deductible means a lower monthly premium, but more you have to pay if you have a claim. A $500 deductible is a great starting point. Fourth building block: comprehensive coverage. This also protects your car, but it's for everything that's not a collision. Theft, vandalism, a tree branch falling on it, hitting a deer, hail damage, fire. It's sometimes called act of God coverage. Like collision, it also has a deductible, and again $500 is a solid baseline. Most people buy collision and comprehensive together as a pair. Fifth and final building block: medical payments or personal injury protection. MedPay or PIP. This covers medical expenses for you and your passengers, regardless of who was at fault in an accident. It's primary coverage, meaning it pays out quickly before any health insurance kicks in. It can cover health insurance deductibles, copays, and things health insurance might not, like dental work or physical therapy. Some states, called no-fault states, require you to carry PIP. Whether it's required or not, having at least $5,000 in this coverage is a smart move for very little cost. So let's put it all together. This is your new mission. This is the policy you are going to get quotes for. This is your golden standard. Liability at 100/300/100. Uninsured/underinsured motorist that matches at 100 to 300. A $500 deductible for both collision and comprehensive coverage. And at least $5,000 in medical payments or PIP. This is the apple. Now and only now are you ready to shop. You aren't looking for the cheapest price. You are looking for the cheapest price on this specific protective policy. You will now force every company to compete on a level playing field for your business on your terms. But knowing this blueprint is only half the battle. Because when you go to these websites, they are filled with subtle design choices, confusing menus, and default settings designed to steer you away from this exact setup and back toward their cheap, high-risk, high-profit plans. You have to know how to navigate their system to get the quote you actually want, not the one they want to sell you. And that's exactly what we're doing next. I'm going to show you, click by click, how to master the online quote form and avoid the traps they set for you. Alright, let's pull up a typical online quote form. They all look a little different, but they all ask for the same core information. The first page is always the easy part, the basics. Your name, your date of birth, and your address. This is the first checkpoint. Your age is one of the biggest factors in what you pay, that's no surprise. But your address is just as critical. They aren't just making sure you live where you say you do. They're running your zip code against a massive database of risk. They know the theft rates, the number of accidents, the weather patterns, even the quality of road maintenance in your specific neighborhood. Moving 2 blocks can sometimes change your rate by hundreds of dollars. But here on this first page lies the very first trap, and it's the one that annoys people the most. It's the phone number and email address fields. The moment you type those in and click next, you've just become a lead. Your information is now in their system, and even if you don't finish the quote, you've given them permission to contact you. Forever. You'll get emails. You'll get text messages. And you will absolutely get phone calls from eager agents trying to help you finish your quote. It's a sales funnel and you just stepped into the top of it. So, how do you get the information you want without becoming a target? You play their game but with your own rules. Before you even start this process, I want you to do 2 things. First, go to Google and set up a free Google Voice account. Takes 5 minutes. It will give you a brand new, functional phone number that forwards to your real phone, but one that you control completely. You can screen calls, block numbers, and when you're done shopping for insurance, you can turn it off entirely. No more unwanted calls. Second, create a new throwaway email address. Something simple like carquotes2026@email.com. This is your dedicated insurance shopping email. All the quotes, the confirmations, and the inevitable follow-up marketing will go to this inbox, not your personal one. You are building a digital wall between you and the sales machine. You are now in control. You get the information and you decide who, if anyone, you want to talk to. Okay, let's click next. Now we're at the vehicle information section. This is where precision is everything. You'll see options to enter your car's year, make, and model from a drop-down menu. Ignore that. Look for the option that says, enter your VIN, the vehicle identification number. It's that 17-digit code on your dashboard on the driver's side, or on the sticker inside your driver's door. Why is this so important? Because 2023 Honda Accord isn't enough information. Is it the LX model? The XL? The Hybrid Touring? Each of those trim levels has a different value, different repair costs, and crucially different safety features. When you enter the VIN, the system knows exactly what car you have. It knows you have anti-lock brakes, electronic stability control, lane departure warnings, and forward collision alerts. Each of those is a potential discount. If you select your car from a generic drop-down, you might miss out on those discounts because the system doesn't know for sure that you have them. Using the VIN is the single best way to ensure you're getting credit for every safety feature your car came with from the factory. Next, they'll ask about the vehicle's primary use. This is a sneaky one. The options are usually commute, pleasure, and sometimes business or farm. Most people just click commute without thinking. But what does that actually mean? To an insurer, commute means you are driving the car to and from the same location, usually a workplace or school, on a regular basis multiple times a week. Pleasure means you don't have a regular commute. You use it for errands, weekend trips, and general driving around. The difference in your premium can be significant because a regular commute, especially during rush hour, is considered higher risk than occasional pleasure driving. Be honest here. If you work from home and only use your car for groceries and seeing friends, you are a pleasure driver. Don't pay for commute risk you aren't actually exposed to. Right below that, you'll find the question about annual mileage. This is where everyone just throws out a random number. 10,000, 12,000, 15,000. Stop guessing. This is a number you can and should calculate. If you have a commute, figure out the round trip distance. Let's say it's 20 miles. You do that 5 days a week. That's 100 miles a week. Let's say you work 50 weeks a year. That's 5,000 miles just for your commute. Now add in your weekend driving and errands. Maybe another 100 miles a week? That's another 5,200 miles a year. So your total is 10,200 miles. Use that number. Why? Because insurers buy this data. They have sophisticated models that estimate average mileage based on your location and demographics. If you claim you only drive 3,000 miles a year but live 40 miles from your office in a rural area, a red flag goes up. Being accurate protects you. Grossly underestimating your mileage to get a lower rate can be considered fraud. If you have a major accident and your odometer shows you drove 15,000 miles when you claimed you only drive 5,000, they have grounds to challenge or even deny your claim. Calculate it, be realistic, and be honest. Now for the driver information. This is about you and anyone else who might drive your car. The form will ask for your name, date of birth, marital status, and license information. It will also ask you to list all other licensed drivers in your household. This is a critical, non-negotiable step. The biggest mistake people make here trying to save money is forgetting to list their 17-year-old son who just got his license, or their spouse who has a couple of speeding tickets. They think, well, they won't be driving my car, so I'll just leave them off. This is a catastrophic error. Insurance follows the vehicle. If your son, who you conveniently left off the policy, takes your car to the store and gets into an accident, you are facing a potential claim denial. The insurance company will say you committed material misrepresentation by not disclosing a known driver in your household. They can refuse to pay for the damages, leaving you on the hook for tens or even hundreds of thousands of dollars. They could also cancel your policy back to the day you bought it, meaning you never had coverage at all. You must list every licensed driver in your household, period. Even if it's your elderly parent who only drives once a month or your college-age kid who is away at school but comes home for the holidays. If they have a license and live under your roof, they need to be on the policy. You can sometimes exclude a driver, which is a formal endorsement stating that person has absolutely no coverage if they drive your cars. But this is a serious step you need to discuss with an agent. For an online quote, always list everyone. The next few questions might seem invasive, but they're all part of the risk algorithm. Occupation, education level, homeownership status. Why do they care if you have a master's degree or if you're a registered nurse? It's all about statistics. Decades of data have shown them that people in certain professions, or with higher levels of education, tend to be more responsible drivers and file fewer claims. It's a correlation, not a judgment. Engineers, scientists, teachers, and pilots often get slightly better rates. So, if you have a college degree or a professional certification, make sure you select it. Don't leave a potential discount on the table. Finally, we arrive at the section everyone dreads, driving history. This is where they ask about your accidents, claims, and traffic violations, usually within the last 3 to 5 years. And here is the single most important piece of advice I can give you for this entire process. Do not lie. Do not omit anything. Don't try to hide that speeding ticket from 2023. Don't forget about that minor fender bender where you filed a claim. Why? Because they already know. Before they give you a final bindable quote, they are going to pull 2 reports on you. The first is your motor vehicle record, or MVR, from your state's DMV. It lists all of your tickets and violations. The second is a CLUE report, which stands for Comprehensive Loss Underwriting Exchange. It's like a credit report for insurance. It lists every auto insurance claim you've ever filed. When you fill out the application, their system gives you a preliminary quote based on what you told them. But when you go to buy the policy, their computers pull the MVR and CLUE reports in real time. If the speeding ticket you forgot is on your MVR, your rate will suddenly jump up by 20%. The quote is re-rated on the spot with the correct information. The only thing you accomplish by hiding it is getting an inaccurate, artificially low quote that wastes your time and gives you a nasty surprise at the end. Be upfront. List the ticket. Disclose the accident. The quote you get will be real, it will be accurate, and you won't be accused of misrepresentation. You're just confirming the information they are going to find anyway. So we've filled out our personal info securely, detailed our vehicle with precision, listed our drivers honestly, and owned up to our driving history. We have successfully navigated the first half of the maze. We've fed the machine all the raw data it needs. But now comes the most important part. Now we have to actually choose the insurance. This next section on coverages, liability limits, and deductibles is where people make the most expensive mistakes. This is where you can either build a suit of armor that protects your entire financial life, or buy a paper-thin policy that will fall apart the second you actually need it. And I'm going to show you how to tell the difference. So let's pull back the curtain. When you get an insurance quote, you're looking at a document called a declarations page. It sounds official and boring, but this is the blueprint for your financial safety. It's the list of ingredients in your policy. And the first most important ingredient, the one required by law in nearly every state, is liability coverage. Think of liability as your financial shield. It doesn't protect your car. It doesn't protect you. It protects your entire life savings from being taken by someone else you accidentally injure, or whose property you damage. This is the coverage that pays for the other guy's problems when the accident is your fault. It's broken into two parts: bodily injury liability and property damage liability. When you see those numbers on your quote like 25/50/25, it's not a secret code. It's a limit. That first number, 25, means your insurance will pay a maximum of $25,000 for a single person's medical bills in an accident you cause. The second number, 50, means the total they'll pay for all injuries in that single accident is capped at $50,000, even if you hit a minivan with 5 people inside. And that last number, 25, means they'll pay a maximum of $25,000 to repair or replace whatever property you damaged, whether it's a '98 Honda Civic or a brand new Tesla. Now, here is the single biggest trap in auto insurance. Most states have legally required minimums, and they are terrifyingly low. That 25/50/25 I just mentioned, that is the state minimum in several states. Let's play this out. You're driving home, you glance at your phone for a split second, and you rear-end a new Ford F-150. The driver has a whiplash injury and a broken wrist. His initial hospital visit, ambulance ride, and follow-up care easily top $30,000. Your policy only covers $25,000. You are now personally on the hook for the remaining $5,000. But it gets worse. The damage to his truck? A modern truck with sensors, cameras, and a specialized tailgate can easily cost $15,000 to repair. Your policy's $25,000 property damage limit covers that, fine. But what if you didn't hit a truck? What if you swerved and hit a new Lexus? Or a BMW? Or 2 cars? That $25,000 property damage limit is gone in an instant. Suddenly, you're facing a bill for $30,000 in car repairs on top of the $5,000 in medical bills. That's $35,000 of your own money. The other driver's insurance company will pay their client, and then their lawyers will come after you to get that money back. They will garnish your wages. They will put a lien on your house. They will drain your savings. All because you tried to save $12 a month by getting the state minimum. The state minimum isn't designed to protect you. It's designed to protect everyone else from you, and only up to a laughably small amount. Buying state minimum liability is like going into a sword fight with a butter knife. The absolute cheapest way to get insurance is to raise your liability limits as high as you can comfortably afford. I'm talking 100/300/100 or even 250/500/100. The cost to go from state minimum to genuinely protective coverage is usually less than the price of a few cups of coffee a month. It is the best money you will ever spend. Okay, so that's liability. That's for the other guy. What about your car? This is where collision and comprehensive coverage come in. People often confuse these, but it's simple. Collision coverage pays to repair or replace your car if you hit another object. Another car, a pole, a guardrail, a fire hydrant. If you are at fault, this is the coverage that fixes your vehicle. You backed into a pillar in a parking garage? That's collision. You slid on ice and hit a curb, messing up your axle? That's collision. Without it, you're paying for those repairs entirely out of your own pocket. If you have a loan or a lease on your car, the bank will almost always require you to have this. They want to protect their investment. Now, with both collision and comprehensive, you'll have a deductible. This is the amount of money you have to pay out of pocket before the insurance company pays a single dime. Deductibles are typically $500 or $1,000. If you have a $1,000 deductible and you cause $4,000 in damage to your car, you pay the first $1,000, and the insurance company pays the remaining $3,000. This is one of the primary levers you can pull to control your price. Raising your deductible from $500 to $1,000 can significantly lower your premium, but you have to be honest with yourself. Could you write a check for $1,000 tomorrow without it causing a financial crisis? If not, a lower deductible might be worth the higher monthly cost. So if collision is for hitting things, what's comprehensive? Comprehensive is for almost everything else. It's the acts of God and acts of chaos coverage. A tree branch falls on your car during a storm. That's comprehensive. Your car gets stolen. Comprehensive. It's damaged by a flood, a fire, or a flock of angry birds. Comprehensive. You're driving down a country road at dusk, and a deer decides to redesign your front end. That's comprehensive. Think of it this way. If your car is damaged while it's moving and you hit something, it's probably collision. If your car is damaged by pretty much any other external force, it's probably comprehensive. Just like collision, it has a deductible, and just like collision, it's usually required if you have a loan. Many people with older, paid-off cars consider dropping these two coverages to save money. That's a personal financial decision, and we'll break down the math on when that makes sense in a later part of this guide. Now for the one that people skip all the time, and it is a catastrophic mistake. Uninsured and underinsured motorist coverage. This is not for them. This is for you. This coverage protects you and your family when you are hit by someone who either has no insurance at all, or who has those pathetic state minimum policies we just talked about. Let's revisit our accident. But this time you're the victim. You're sitting at a red light, and someone texting and driving plows into the back of you. Your car is wrecked and you have serious back and neck injuries. You're out of work for 3 months. Your medical bills are $80,000. Your lost wages are another $15,000. That's $95,000 in damages. The person who hit you, let's say they have insurance, the state minimum of $25,000 in bodily injury liability. Their insurance company writes you a check for $25,000. That's it. That's all they are legally obligated to pay. Where does the other $70,000 come from? If you don't have underinsured motorist coverage, it comes from you. You can try to sue the at-fault driver personally, but let's be realistic. If they could only afford the cheapest possible insurance, do you think they have $70,000 sitting in a bank account? Of course not. You'll spend years in court to maybe get a judgment against them that you'll never be able to collect. But if you have underinsured motorist coverage, your own insurance company steps in and acts like the insurance company the other driver should have had. They cover your remaining medical bills. They cover your lost wages, up to the limits you selected. It turns a life-destroying financial disaster into a manageable crisis. Uninsured motorist coverage does the same thing, but for when the at-fault driver has no insurance whatsoever, which studies show is about 1 in every 8 drivers on the road. Do not skip this. Match your uninsured and underinsured limits to your own bodily injury limits. Insure yourself as well as you insure a stranger. Finally, there's a smaller, but very useful coverage called medical payments or MedPay. In some states, it's a more robust version called Personal Injury Protection, or PIP. This is simple. It pays for initial medical expenses for you and your passengers, regardless of who is at fault. If you have a $2,000 health insurance deductible, MedPay can cover that. If your passengers don't have health insurance, it can cover their emergency room visit. It's relatively cheap, and it provides immediate peace of mind without having to wait for fault to be determined. So there you have it. Liability, collision, comprehensive, uninsured/underinsured motorist, and MedPay. These are the 5 core building blocks of any solid auto insurance policy. Understanding these isn't just about getting a cheap quote. It's about understanding exactly what you are buying. You are buying protection. You are buying security. You are building that suit of armor. Now that you know what the pieces are, we can finally start talking about the secret discounts and little-known strategies to get those pieces for the absolute lowest price possible. Let's start with the most misunderstood concept in the entire insurance industry: discounts. Most people think of discounts as little coupons, a nice bonus if you happen to qualify. That is fundamentally wrong. Discounts are not a bonus. They are the entire game. Your final premium is not a base price minus a few discounts. Instead, think of it like this. The insurance company starts with a ridiculously high worst-case scenario price for someone your age, in your zip code, driving your car. Every single discount you claim is a step down from that nightmare number, bringing you closer to the rock-bottom price you actually deserve. Your job is to systematically dismantle that high price piece by piece, by actively claiming every single discount you are entitled to. They will not volunteer this information. You have to know what to ask for. So let's build your discount arsenal, starting with the driver. The most common one is the good driver, or accident-free discount. This sounds simple, but here's the inside scoop. This discount is often the largest single percentage you can get, sometimes up to 25 or 30%. But it's fragile. One speeding ticket, even a minor one, can wipe it out for 3 to 5 years. Think about that. A single ticket for going 10 miles over the speed limit might only cost you $150 today, but it could cost you an extra $800 in lost insurance discounts over the next 3 years. Suddenly, fighting that ticket or going to traffic school looks a lot more appealing, doesn't it? It's not about the fine. It's about protecting your discount. Next up, the good student discount. If you or a driver on your policy is in high school or a full-time college student with a B average or better, this is an easy 10 to 15%. But here's the pro tip most people miss. Many companies extend this for a year or two after graduation. They know that good study habits often translate to responsible behavior. Furthermore, if your student is away at college over 100 miles from home without a car, you can get a student away at school discount, which can be even bigger. You have to ask for both. Now let's talk about the modern-day game-changer: telematics, or usage-based insurance. This is where your insurance company gives you a small device to plug into your car, or asks you to download an app on your phone. It's programs like Progressive Snapshot or Allstate's DriveWise. This device tracks your actual driving habits: how fast you accelerate, how hard you brake, what time of day you drive, and how many miles you drive. Now, I know what you're thinking: privacy. And that's a valid concern. You are trading some of your data for a potentially massive discount. But here's why it's so powerful. For decades, insurance was based on demographics, crude categories like your age, gender, and zip code. Telematics shatters that. It allows you to prove that you, specifically, are a safe driver regardless of what the statistics say about other 22-year-old males in your city. If you're a night shift nurse who has to drive at 3 a.m., traditional models penalize you. With telematics, you can prove you're driving safely on empty roads. If you work from home and barely drive 5,000 miles a year, this is your golden ticket. The best part? Most companies offer a small initial discount just for trying it, and in most states they cannot raise your rates based on the data, only lower them. It's a free shot at proving you're better than average. Let's move on to the vehicle itself. Your car is a walking, talking collection of potential discounts. Anti-lock brakes? That's a discount. Airbags? Discount. Daytime running lights? Discount. But the big ones are anti-theft systems. If your car has a passive alarm system that arms itself automatically, that's a significant discount. If you have a vehicle recovery system like LoJack, that's an even bigger one. Insurers love this stuff because it directly reduces their two biggest risks: the car being stolen and you getting hurt in a crash. Go through your car's manual or original window sticker and make a list of every single safety and anti-theft feature. Cross-reference that list with your insurer's discount offerings. Don't assume they know you have it. You need to tell them. Okay, let's get into the policy-level strategies. The easiest win on the board is the multi-policy or bundling discount. Insuring your car and your home or apartment with the same company can easily save you 10 to 20% on both policies. Here's the psychology behind it. The insurance company knows that the more policies you have with them, the stickier you become as a customer. It's a bigger hassle for you to shop around and move everything, so you're more likely to stay with them for years. They are buying your loyalty. Use this to your advantage. Always, and I mean always, get a quote for both your auto and home/renter's insurance at the same time, even if they are with different companies right now. Next, how you pay. This is so simple, but almost half of people get it wrong. Do not pay monthly. Monthly payments almost always come with a service fee of $3 to $8 per payment. That's nearly $100 a year just for the privilege of splitting up your bill. If you can afford it, choose the paid in full option. Most companies will give you a 5 to 10% discount right off the top. If you can't swing the full 6-month premium at once, ask about electronic funds transfer or EFT, where they automatically pull it from your checking account. This usually waives the service fees and sometimes comes with its own small discount because it guarantees they get paid on time. Now for the two biggest secret factors that most people have no idea are dramatically impacting their rates. The first is your occupation. Yes, your job title can save you money. Insurers have mountains of data showing that people in certain professions are statistically safer drivers and file fewer claims. Who are they? Engineers, scientists, teachers, first responders, nurses, and military personnel often get special discounts. They are seen as more meticulous, risk-averse, or community-oriented. If you fall into one of these categories, you must declare it. The second, and arguably the most powerful hidden factor, is your credit score. In every state except California, Hawaii, and Massachusetts, insurers are legally allowed to use a credit-based insurance score to help set your rates. This is not the same as your FICO score, but it's heavily based on it. The logic, backed by actuarial data, is that individuals who manage their finances responsibly also tend to manage their other responsibilities, like driving, more carefully. The correlation between a high credit score and a low claims history is incredibly strong. This means that improving your credit score is one of the most effective long-term strategies for lowering your insurance premiums. Pay your bills on time, keep your credit card balances low, and check your credit report for errors. Fixing one error on your report could save you hundreds of dollars a year on insurance for life. It's the invisible discount you give yourself. Finally, think about every group you belong to. Are you a member of an alumni association, a credit union, a professional organization, a warehouse club like Costco or Sam's Club? Many of these groups have negotiated special group discounts with insurance carriers. It's a win-win. The insurer gets access to a large pool of desirable customers, and you get a better rate. Brainstorm a list of every single organization, club, or association you are a part of. When you're getting quotes, ask the agent, "Do you offer any affinity group discounts?" And then read them your list. You'll be shocked at what you might uncover. These aren't just tips, this is a checklist. This is your pre-flight inspection before you ever go online to get a quote. By gathering this intelligence first, your driver history, your car's features, your payment preferences, your job, your credit, and your affiliations, you are no longer just a passive consumer accepting a price. You are an informed negotiator, armed with the exact information needed to systematically take apart their highball offer and build your own rock-bottom rate. Now you hold the keys. You have the data points that insurance companies use to judge you, to price you, to put you in a box. But knowledge without action is just trivia. It's time to take that intelligence and deploy it on the digital battlefield. This is where the war for the lowest rate is won or lost. And the first rule of any conflict is to know the terrain. In the world of online insurance quotes, there are 3 distinct territories you must navigate, and each has its own rules, its own traps, and its own treasures. First, you have the aggregators. Think of these as the grand bazaars of insurance. Websites like the Zebra, Gabi, or Jerry.ai. Their promise is seductive. Enter your information once, and they will summon quotes from a dozen, sometimes 24 different carriers. It's a powerful tool. It's your reconnaissance drone, giving you a bird's-eye view of the entire market in minutes. You can see instantly who the major players are for someone with your specific profile. Is it Progressive? Is it Travelers? Is it a smaller company you've never even heard of? The aggregator gives you the lay of the land. But, and this is a critical but, they are not perfect. They are a starting point, not the destination. Sometimes their connection to the insurance company's live pricing, their API, isn't perfect. It might miss a niche discount. It might not factor in a specific detail you entered. And more importantly, some of these sites make their money by selling your information as a lead. You become the product. So, we use the aggregators for what they are. An incredible tool for initial intelligence gathering, but not the final word. The second territory is far more treacherous. These are the sirens of the internet, the lead generation traps. They look and feel just like aggregators. They promise you quotes, they have flashy buttons and reassuring logos, but they have no intention of giving you a price. Their entire business model is to capture your name, your email, and most importantly, your phone number, and sell it in real time to a list of hungry, commission-based agents in your area. You'll know you've stumbled into one of these traps when the questions are vague, and very early on, they demand your phone number to unlock your special rates. The moment you hit submit, your phone will begin to vibrate, and it will not stop for days. You will be hounded by agents from companies you've never heard of, all trying to pressure you into a sale. These sites are a waste of your time and an assault on your peace of mind. Avoid them at all costs. A legitimate tool will show you real, comparable numbers on the screen before ever pressuring you for a phone call. The third territory is the fortress. This is the direct carrier website, going straight to geico.com, progressive.com, or statefarm.com. This is where the final, most accurate price lives. These are the companies themselves using their own up-to-the-second pricing algorithms. The advantage here is precision. You are getting the price from the source. They often have unique online-only discounts that they don't offer through the aggregators to incentivize you to come directly to them. The disadvantage? It's a brutal, time-consuming grind. Filling out your information, your VIN numbers, your driving history again and again and again on 5, 6, 7 different websites is exhausting. It's what causes most people to give up and just settle for good enough. So how does the savvy negotiator, armed with their personal data, conquer this landscape without wasting a whole weekend? You don't attack randomly. You use a strategy. Let's call it the trifecta method. It's a 3-step assault that maximizes efficiency and guarantees you find the absolute floor on your premium. Step 1, the aggregator sweep. You will pick one, maybe two of the top-tier reputable aggregator sites. You will meticulously fill out your profile with the information you've already prepared. You'll run the search. This is your 10-minute reconnaissance mission. Your goal here is not to buy anything. Your goal is to identify the top 3 cheapest carriers for your profile. That's it. You're just looking for names and numbers. Let's say the aggregator tells you that for your 2023 Honda CR-V in suburban Ohio, the top 3 are Progressive at $118 a month, Travelers at $125 a month, and a company called Root Insurance at $115 a month. You now have your targets. Step 2, the direct assault. You are now going to ignore all the other names on that list. You are going to open 3 new tabs in your browser. One for Progressive, one for Travelers, and one for Root. You are now leaving the Grand Bazaar and knocking on the gates of the fortress itself. Yes, this means you will have to enter your information 3 more times. But this is not wasted effort. This is the work that saves you hundreds, even thousands of dollars. You are going to fill out their direct quote applications with the exact same information. Pay close attention. Does the direct website ask a question the aggregator didn't? Maybe it asks about the specific anti-theft device in your car, or if you park in a garage versus a driveway. These small details can shave off real dollars. After you've completed the quotes, you might find that Progressive Direct is now $114, Travelers is $122, and Root is still $115. You have just found an extra $4 a month, nearly $50 a year, in 10 minutes of focus work. You have now confirmed the absolute lowest digitally available price. But we are not done. The digital price is just the company's opening offer. The final step is what separates the amateur from the pro. Step 3, the human override. You have your lowest quote. Let's say it's Progressive at $114 a month. You now find their phone number. You are going to make a single 5-minute phone call. When you get an agent on the line, you are not going to be aggressive. You are going to be polite, informed, and ready to buy. You'll say something like this: "Hi, I just completed a quote online. Reference number 12345. Came back at $114 a month, which is a great price. I'm ready to switch my policy today. My current provider is your current insurer, and I've also received a quote from mention one of the other carriers like Root for around $112. Before I make my final decision, I just wanted to ask, is this $114 the absolute best possible rate you can offer? Are there any other discounts, like a pay-in-full discount, a paperless billing discount, or a professional organization discount, that we could apply to get that number just a little bit lower?" You see what you've done? You've shown them you are a serious customer. You've introduced competition. And you've specifically prompted them to look for discounts that the online system might not automatically apply. The agent on the other end is often incentivized to close the deal. They have tools and discretion that the website doesn't. They might say, "Well, let me take a look here. Ah, I see the system didn't automatically add the EFT payment discount. If you set up automatic payments, I can knock that down to $109 a month." Boom. Another $60 a year saved, all from a single 5-minute phone call. This trifecta method, sweep, assault, and override, turns a confusing, frustrating process into a systematic plan of attack. You leverage the speed of technology to do the heavy lifting, then apply a human touch to secure the final rock-bottom price. You are no longer just clicking buttons and hoping for the best. You are executing a strategy. You are treating this not as a chore, but as a high-paying job. If you spend 2 hours on this entire process and save yourself $40 a month, you haven't just saved $480 for the year. You have effectively paid yourself $240 an hour tax-free for your time. Tell me another job that pays that well. But getting the lowest number, that magic dollar figure, is only half the battle. Because the cheapest quote can hide the most expensive traps. A low premium means nothing if your deductible is a nightmare, your liability limits are dangerously low, or the policy is riddled with exclusions that will leave you financially ruined after an accident. And in the next part, we're going to uncover the fine print deceptions and policy loopholes that can turn a cheap insurance policy into a financial catastrophe waiting to happen. This is where the game is truly won or lost. Not on the glossy homepage with the friendly gecko, but deep within the digital equivalent of a dusty, forgotten filing cabinet, the policy document. This document, often a 40-page PDF filled with dense legalese, is not a suggestion. It is a binding contract, and every single word is a potential financial landmine. The insurance company's lawyers wrote it, and trust me, they didn't write it to benefit you. They wrote it to protect the company. Your job is to learn how to navigate this minefield. Let's talk about a woman we'll call Jessica. Jessica was smart, savvy, and a master of finding online deals. She used a comparison site, found a policy that was $60 a month cheaper than her previous one, and celebrated her financial victory. She skimmed the documents, saw the big numbers she recognized, liability, collision, comprehensive, and signed on the digital dotted line. A year later, her brother's car was in the shop, so she let him borrow hers to run a quick errand to the grocery store, less than 2 miles away. On his way back, a driver ran a red light and T-boned him. Her car was totaled, and the other driver was injured. A terrible situation, but that's what insurance is for, right? Wrong. When Jessica filed the claim, she got a letter a week later. The subject line read, "Denial of claim." Her heart sank. Buried on page 17 of her policy, under a section titled Policy Exclusions, was a clause she'd never even heard of, a named driver exclusion. Her policy, the one that was $60 cheaper, achieved those savings by explicitly stating that the only person on planet Earth covered to drive her car was her, Jessica, no one else. Not her brother in an emergency. Not her best friend acting as a designated driver. Not her parent visiting from out of town. The moment her brother sat in the driver's seat, her multi-thousand-dollar insurance policy became as worthless as a blank sheet of paper. She was now personally on the hook for the value of her totaled car, the other driver's medical bills, and the ensuing lawsuit. That $60 a month savings just cost her over $80,000 and led to bankruptcy. This isn't a rare, one-in-a-million scenario. It's a common trap deliberately built into ultra-cheap policies. And it's just the tip of the iceberg. The second loophole you have to watch out for is the business use exclusion. This has become a financial nightmare for millions of people in the gig economy. You think you're just using your car to get around? What if you decide to make a few extra bucks delivering for DoorDash on a Friday night? Or driving for Uber? Or even using your car to deliver packages for Amazon during the holidays? The second you turn on that app and accept a ride or a delivery, most standard personal auto policies become instantly void. If you get into an accident, even if it's not your fault, and the company discovers you were using the vehicle for commercial purposes, they will deny your claim. They will walk away, and you will be left to face the financial fallout alone. They'll say you needed a commercial policy or a special rideshare endorsement, something that was never mentioned when you were clicking buy now on their website. Let's move on to the third hidden trap, the custom parts and equipment exclusion, or CPE. Did you put new wheels on your car? An upgraded sound system? A custom paint job or a vinyl wrap? Congratulations, you just invested thousands of dollars that your cheap insurance policy has absolutely no intention of ever covering. A standard policy covers the car as it left the factory, and that's it. So when your car is stolen and stripped, and you tell the insurance adjuster about your $2,000 audio system and your $3,000 rims, they're going to look at their chart and offer you the value of the stock stereo and the basic steel wheels. To get that extra equipment covered, You need to specifically add a CPE rider to your policy and pay an extra premium. Most people never do because they don't even know it exists. They assume full coverage means the car is fully covered. Doesn't. It means the parts the manufacturer installed are covered. Now for one of the sneakiest deceptions in the entire industry, the step-down liability clause. This one is truly diabolical. You buy a policy with great liability limits, let's say 100/300/50. That means $100,000 for bodily injury per person, $300,000 per accident, and $50,000 for property damage. You feel protected, but hidden in the fine print is a clause that says if a permissive user, that is, someone who isn't on the policy but is driving with your permission, gets into an accident, the coverage limits automatically step down to the state-required minimum. In many states, that could be as low as 25/50/10. So, your friend borrows your car, causes a serious accident, and that robust $300,000 safety net you paid for suddenly shrinks to a pathetic $50,000. Any damages above that become your personal responsibility. The insurance company sold you a premium policy, but delivered a bare-bones one when you needed it most. It's a contractual bait-and-switch. Finally, there's the fifth and most terrifying loophole: the erosion of the duty to defend. Historically, if you were sued after an accident, your insurance company had a broad duty to defend you, meaning they paid for the lawyers and court costs, regardless of the policy limit. But newer, cheaper policies are rewriting this rule. They include language that says their duty to defend ends once they've paid out the policy limit. Think about what this means. Let's say you have a $50,000 property damage limit, and you cause an accident that results in $90,000 of damage. The other party sues you. Your cheap insurance company can simply write a check for $50,000 to the other party, and then wash their hands of you. They'll send you a letter saying, "We've fulfilled our contractual obligation. The lawsuit is now your problem. Good luck." You are now left alone without a lawyer to fight a lawsuit for the remaining $40,000 plus all the legal fees. That cheap premium just cost you your entire defense. So how do you protect yourself from this? You have to become an interrogator. Before you ever pay a dime, you must get a full copy of the proposed policy document, not the marketing summary, the actual contract. And you need to be able to answer 5 specific questions. 1. Who, by name or definition, is explicitly covered to drive this vehicle? And who is explicitly excluded? Find the exact sentence. 2. Under what specific circumstances or uses is this vehicle not covered? Look for keywords like business, commercial, delivery, racing, or for hire. 3. How is custom equipment handled? Is there a separate limit, and if so, what is it? Is it 0? 4. Do my liability limits ever step down under any circumstances, like for a permissive user? Get a yes or no. 5. What is the company's exact duty to defend me in a lawsuit? Does it end when the policy limit is paid? You must be able to physically point to the answers to these 5 questions within the text of the contract. If you can't find the answer, or if you don't understand the language, you must not buy the policy. This isn't about being paranoid. It's about being prudent. The price tag you see online is only half the story. The real cost is written in the fine print. But even if you find a policy with a solid contract, you're not safe yet. Because the next battle begins when you actually have to file a claim. And that's where you'll discover the silent weapons that insurance companies use to delay, deny, and underpay legitimate claims, even from their most loyal customers. The moment an accident happens, the clock starts ticking. Not on your recovery, but on their strategy. The smiling agent who sold you peace of mind is gone. In their place is a team of adjusters, analysts, and lawyers whose job, let's be brutally honest, is not to make you whole. Their primary fiduciary duty is to their shareholders. It's to protect the company's bottom line. And you, their loyal premium-paying customer, have just become a liability on a spreadsheet. A number to be minimized. The first weapon they deploy is almost always psychological. It's called the delay game. It's a war of attrition. They know you're stressed. You might be injured, you're without a car, your life is upside down. You need a resolution and you need it now. And they use that desperation against you. Your adjuster suddenly becomes impossible to reach. Voicemails go unreturned. Emails vanish into a black hole. When you do get someone on the phone, they need just one more form. Or they're waiting on a report from another department. Every delay is a calculated move designed to exhaust you, to make you feel powerless, to grind you down until you're so desperate you'll accept any offer they throw at you, just to make it all stop. While they're delaying, they'll try to deploy their second silent weapon, the recorded statement trap. An adjuster will call you, their voice dripping with sympathy. They'll say, "I just need to get your version of events for the record. It's just a formality." It is not a formality. It is an interrogation disguised as a conversation. They are not your friend. They are a trained professional looking for any word, any hesitation, any turn of phrase they can twist to their advantage. They'll ask seemingly innocent questions. "How are you feeling today?" If you say, "I'm fine, thanks," and 2 weeks later you're diagnosed with severe whiplash, they will use that recording in court. But on the day after the accident, you told our adjuster you were fine. They'll ask you to speculate. Do you think you could have swerved a little sooner? Were you distracted at all, even for a second? They are baiting you into admitting partial fault. Even 1% of fault can drastically reduce your payout in many states. You are under no legal obligation to provide a recorded statement, especially for the other driver's insurance company. Never, ever agree to one without consulting an attorney. The single most powerful sentence you can learn is, "I am not comfortable providing a recorded statement at this time, but I will submit all necessary information in writing." End of conversation. Let's say you navigate that minefield. Now comes the financial assault. Weapon number 3. The swoop and settle. This is when the adjuster, knowing you're in a tight spot, calls you up with a seemingly generous offer. "Look, your car has about $7,000 in damage, and you've got some medical bills. We can cut you a check right now for $4,000. No more paperwork, no more waiting. You can have the money in your account by tomorrow." Sounds tempting. It's fast cash when you need it most. But it's a trap. They are preying on your financial anxiety. That $4,000 might cover the immediate repairs at their cheap, preferred shop, but it won't cover the rental car you needed for 3 weeks. It won't cover the physical therapy your doctor just prescribed. And it certainly won't cover the fact that your car, now with an accident on its record, has just lost thousands of dollars in resale value. Something called diminished value, which you are often entitled to claim. Once you accept that check and sign that release form, your claim is closed. Forever. You can never go back and ask for more, even if your injuries turn out to be permanent. The first offer is almost never the best offer. It's a test. It's a probe to see how little you're willing to accept. This often goes hand in hand with their fourth insidious tactic, the preferred shop ploy. Your insurer will tell you they have a network of approved or preferred auto body shops. They'll make it sound like a concierge service. "Just take it to ABC Auto, we'll handle everything. It'll be so much faster." Faster for them, maybe. But what you need to know is that these shops often have a contractual relationship with the insurance company. To get a steady stream of business, they agree to work within the insurer's strict cost guidelines. This can mean using cheaper, aftermarket parts instead of original equipment manufacturer, or OEM parts. It can mean cutting corners on labor to get the job done faster and cheaper. Your state's laws almost certainly give you the absolute right to have your vehicle repaired at any shop of your choosing. The insurance company cannot force you to use their preferred shop. They can only recommend it. Insist on a reputable, independent shop that works for you, not for the insurance company. A shop that will fight to use OEM parts and restore your vehicle to its pre-accident condition, not just the acceptable condition defined by an adjuster's budget. So how do you fight back against this corporate playbook? You create your own. You become the most organized, difficult, and well-documented claimant they've ever seen. Counter the delay game with a relentless paper trail. After every phone call, send a follow-up email summarizing the conversation. "Dear John, per our conversation today at 2:15 p.m., you stated you would have an update for me within 48 hours. I look forward to hearing from you. Now you have a time-stamped record. Communicate through email as much as possible. If they are completely unresponsive, send a formal letter via certified mail. Use phrases like, 'I am concerned about the delay in processing my claim, and please provide a written explanation for this delay.' This documentation becomes crucial evidence if you later need to file a bad faith complaint against them with your state's Department of Insurance. Counter the swoop and settle with your own evidence. Never accept the first offer. Never. Instead, get your own independent estimates for repairs from a shop you trust. Keep meticulous records of every single expense related to the accident. Medical bills, prescription receipts, rental car costs, even lost wages from time off work. Compile it all into a professional-looking demand letter. You're not just asking for money. You are presenting an evidence-based case for why you are owed a specific amount. When they lowball you, you don't just say no. You say, "Your offer of $4,000 is not acceptable. As you can see from the 3 independent estimates and my documented expenses I've provided, my actual damages total $9,500. Please provide a revised offer that reflects this reality." You're no longer a desperate victim. You're a prepared negotiator. You flipped the script. You've taken control away from them and put it back in your hands. But what if they still won't budge? What if they deny a perfectly valid claim or refuse to pay what you are rightfully owed? Most people think their only option at that point is to hire an expensive lawyer. But there is one final, incredibly powerful tool that any policyholder can use. A hidden clause in most insurance policies that can force the company into an entirely different arena. One where their army of lawyers has far less power. It's a consumer's ultimate trump card. And in the final part of this guide, I'm going to show you exactly what it is and how to use it to get every last penny you deserve. It's called your State Department of Insurance. And it is the one entity that every single insurance company, from the smallest local player to the billion-dollar giants, is terrified of. You see, an insurance company can't just set up shop and start selling policies. They need a license to operate in every single state, and that license is granted and overseen by the state's Department of Insurance or a similar regulatory body. This government agency has one primary mission: to protect you, the consumer. They write the rules of the game, and more importantly, they are the referees. They have the power to launch investigations, levy massive fines, and in extreme cases, they can revoke an insurer's license to do business in the entire state. That is the corporate death penalty. So when you have a dispute with your insurer, you aren't just one person against a corporation. You have a silent, incredibly powerful partner waiting in the wings. Knowing how to bring that partner into the fight changes everything. Let me tell you a story about a woman named Sarah. Sarah was a careful driver, always paid her premiums on time. One afternoon, while sitting at a red light, she was rear-ended by a distracted driver. The other driver was clearly at fault. The police report confirmed it. Everything seemed straightforward. Her car, a reliable sedan she loved, was declared a total loss. Based on market research, Kelley Blue Book, and listings for similar vehicles, her car was worth about $15,000. A few days later, the at-fault driver's insurance adjuster called. He was polite but firm. Their offer was $8,500. Sarah was stunned. She explained her research, she sent links to comparable cars for sale, she showed them the receipts for the new tires she just put on. The adjuster wouldn't budge. He used vague terms like regional valuation and depreciation schedule. The message was clear: take it or leave it. For the next 2 months, Sarah was trapped in insurance purgatory. Her calls went to voicemail. Her emails received delayed one-sentence replies. The adjuster knew he had all the power. He was counting on her to get frustrated, to feel helpless, and to eventually give in and take the lowball offer just to be done with the nightmare. He knew that hiring a lawyer for a $7,000 dispute would eat up most of the potential winnings and fees. He had her right where he wanted her. Except Sarah had been watching a video much like this one. She knew about the trump card. So here's what she did, and what you should do in the exact same situation. First, she sent one final formal email. It was addressed to the adjuster, and using a quick LinkedIn search, she copied his direct supervisor. The email was calm, professional, and factual. It restated the facts of the case, the evidence of her car's value, and their insufficient offer. But at the very end, she added the magic sentence: if we are unable to reach a fair and reasonable settlement based on the evidence provided by Friday at 5 p.m., I will be left with no choice but to file a formal complaint with the State Department of Insurance regarding your company's claims handling practices. That sentence is a warning shot. It's a signal that you are not an average, uninformed consumer. Tells them you know the rules of the game and you know who the referee is. In many cases, this alone is enough to get a file magically reevaluated. But in Sarah's case, the adjuster was arrogant. He ignored it. So Sarah moved to step 2. She went to her state's Department of Insurance website. Every state has one. Just Google your state's name plus Department of Insurance. On the site, there was a big clear button that said, File a Complaint, or Consumer Assistance. She clicked it. It brought up a simple online form. This is the critical part. She didn't write an angry, emotional rant. She wrote a clear, concise, and factual summary of what happened, just like a police report. She included names, dates, policy numbers, and the specific dollar amounts. She stated, "The at-fault driver's insurer, Goliath National, has offered $8,500 for my totaled vehicle. Market evidence, which I have repeatedly provided to them, shows a value of approximately $15,000. The company has failed to provide a rational justification for their low valuation and has engaged in delay tactics." Then she uploaded her evidence: the police report, photos of the damage, the repair shop's total loss statement, screenshots of comparable cars for sale, her email correspondence with the adjuster. She attached every single piece of ammunition she had. She hit submit. The entire process took her less than 30 minutes. And then silence. For about a week, Sarah started to worry it was a waste of time. But what she didn't know was that behind the scenes, a powerful chain reaction had begun. Her complaint didn't just go into a black hole. The Department of Insurance assigned it a case number and formally forwarded it to a specific, high-level compliance department within Goliath National. Suddenly, her little $7,000 dispute was no longer on some low-level adjuster's desk. It was on the desk of a team whose entire job is to keep the company from getting fined or investigated by the government. Her file was now radioactive. On the 9th day, her phone rang. It wasn't the original adjuster. It was a woman who introduced herself as a senior claims manager from the corporate office. Her tone was night and day. She was respectful, apologetic. She said, "Miss Sarah, I've reviewed your file and the inquiry from the Department of Insurance. I want to apologize for the delays and the miscommunication you've experienced. After reevaluating the vehicle data, we agree that our initial offer was too low. We are prepared to offer you a settlement of $14,600. Just like that. No more arguments. No more delays. The check was overnight. The nightmare was over. Sarah didn't have to hire a lawyer. She didn't have to go to court. She just had to know which button to push. This strategy isn't just for total loss claims. It works for any legitimate dispute where an insurance company is acting in bad faith. Are they refusing to approve a necessary medical treatment after a crash? Are they delaying the repair of your vehicle for weeks on end with no explanation? Did they deny your claim based on a tricky interpretation of your policy's fine print? The Department of Insurance is your recourse for all of it. They are the equalizer. So as we wrap up this guide, I want you to remember this. Finding the cheapest quote is the start of your journey, not the end. You used all the tools we talked about, the comparison sites, the bundling strategies, the discount deep dives to get a great price. But a cheap policy is worthless if the company behind it won't be there for you when disaster strikes. The price you pay is for the premium. The value you get is in the promise. And the knowledge of how to use your state Department of Insurance is your guarantee that they will keep that promise. It transforms you from a customer they can push around into a constituent they have to answer to. You are no longer David fighting Goliath alone. You are David fighting Goliath with the government standing right behind you. And that is a fight you can win. This is the final piece of the puzzle that turns you from a simple insurance shopper into a truly empowered consumer, ready for 2026 and beyond. If this guide has helped you, if it's opened your eyes to the power you truly hold, do me one small favor and hit that like button and subscribe for more content that puts the power back in your hands. Because knowing how to save a few $100s on your premium is great, but knowing how to make sure you get the tens of thousands of dollars you're rightfully owed when you need it most, that's priceless. Thank you for watching. Stay safe out there and never forget, you hold more power than you think.